Okay, it's only April 9th, and so far in 2025, we've seen some pretty remarkable things happen in the stock market already. In some ways, it seems really kind of extreme, but you'll find after today's video, it might be a little bit more common than you might think. So today I want to go over some really important information for you that will help prevent you from making some mistakes going forward, and not only over the next few weeks, but maybe this entire year or going forward after this year. So if we go back to just last night, the end of April 8th, the S&P 500 was down 16% from January 1st. The Nasdaq, the other big index for our stock exchange, was down 24%, and that's going through the end of April 8th. However, what happened today? Today alone, the S&P 500 went up 9.5% in one day. Did you know that that is the third largest gain, single day gain that we have had in the S&P 500 ever? And in the Nasdaq, it went up 12%. Those are some huge moves for a one-day move. Now, the other thing that's kind of remarkable, I realize that over the last few weeks, a lot of people have been kind of fearful, and that's understandable. It's easy to kind of get worried about what's happening to your 401ks or your investment accounts. However, if we just look back now, 12 months ago, okay, so 12 months from today as I make this video, the S&P 500 is still up 4.5%, and the Nasdaq is still up 5%. I'm sure 12 months ago, nobody was worried about your investments. And yet, for some reason, we're up from that point, and now everybody's panicking. So we need to be careful that we kind of zoom out and take a bigger picture of what's going on. And that's what today is all about. Now, the other thing I want to look at is three funds. Okay, when we talk about the Nasdaq, a lot of people associate that with a fund called QQQ. That's actually the Nasdaq 100. Now, there's well over 3,000 stocks that trade on the Nasdaq exchange. So Fidelity has a fund called 1Q that is meant to be the entire Nasdaq, but it's not. It only has a little over 1,000 of the companies, but it may be a little bit more representative of the entire Nasdaq index, which it's meant to do. But a lot of the companies on the Nasdaq are very, very small companies and thinly traded, so those aren't included. Now, I'm using SPY for a fund for the SP 500 because it's the one that goes back the furthest. It's the oldest S&P 500 ETF. Now, first of all, QQQ started in 1999. So I have a few historical rates of return per year. As you can see, last year in 2024, okay, they were all up relatively the same. QQQ was up 25.6%, let's say. The SP 500 was up about 25%, and 1Q was up about 29%. Now, in 2023, QQQ and 1Q was up much more than the SP 500. But notice in a bad year, okay, in 2022, when the SP 500 dropped 18%, 1Q was down 32%, and so was QQQ. And that's the trade-off. Okay, QQQ and 1Q, both of those, have been outperforming the SP 500 over the last several years, especially since 2020, when kind of like the tech companies, the internet companies, the AI companies really took off. Some of that was due to COVID also. But in the last few years, it's really been outperforming. But we have to remember, when QQQ, let's say, dropped 32%, it has to go up 48% to get back to even. That's how percentages work. The SP 500 dropped 18%. It only has to go up about 22% to get back to even. So if we look at the average over the last few years, it's a little more balanced than you might think. Now, if we go back since January 1st of this year until right now, as I make this video, the SP 500 is down 7.25%. 1Q is down about 12%, and QQQ is down about 9%. Again, that's the trade-off of, trying to pursue growth. QQQ only has the top 100 companies of the Nasdaq. And it's a little more volatile because the Nasdaq is more heavily weighted towards technology. The SP 500 has about 31% in tech companies, and QQQ has about 51% in the tech companies. Now, all of these are what's called market cap weighted, which means more of the money goes to the really big companies. So think of Apple, Nvidia, Microsoft, okay, all of those types of companies. That's where most of the money goes. Less money goes to the really small companies. Now, QQQ, for example, if we go back to when it first started, I believe it was in March of 1999, up until the end of last year, it averaged about 10% rate of return, which is really good over that period of time because the early 2000s were really bad, and then we had the housing crisis and so forth. Actually, this is higher than the SP 500 over that exact period of time. Now, let's go back to some of those years. Notice here in 2008, right in the heart of the housing crisis, QQQ dropped almost 42%. 1Q dropped about 40%, and the SP 500 dropped about 37%. But look at the early 2000s, 2000, 2001, 2002. Over that period of time, the SP 500 over a 3-year period dropped about 49%. You can see QQQ would have dropped a lot more than that. Again, that's the trade-off that we must understand if we are pursuing companies that might give us better growth over the long term. Now, in recent years, a lot of people really like companies like Nvidia and stuff like that, but they get hurt the worst, or QQQ gets hurt the worst if we have bad periods. So you have to accept much more volatility. Over the long term, they might do very well though. Now, let's look at a few other things. These are the largest single day drops for the SP 500. Remember, we just had today the third largest gain in the SP 500 ever. Okay, so it was a crazy good day today, but we've had some bad days before too. Okay, in 1987, October 19th, the SP 500 dropped 20%. Okay, in a day. That's a single day drop. In 2020, it dropped 12% on March 16th. On March 12th, it dropped 9.5%. Okay, that's not that long ago. In fact, in 2020, just during March, the SP 500 dropped 34% in 1 month. And yet, what happened over that entire period, that 1 year period? From January to December, it went up 18%. Again, what is happening in any particular month or even a few months should be irrelevant to us. Now, of course, we have 2008, the housing crisis. December 1st, it dropped almost 9%. Okay. September 29th, it almost dropped 9% again. Okay. We had the crash of on October 26th, a few days after that big drop, it dropped another 8%. Okay. October 9th of 2008. And you can see here's the single biggest drops for the Nasdaq. Again, large drops happen occasionally. Okay. It's pretty common. In fact, the type of decline, this is going back from 1954 to December of 2023. Okay, we've had a 5% or more drop roughly about once a year. It's common. Okay, a 10% or more drop. Okay, about every 30 months. So, almost every year. A 15% drop in the market happens about once every 5 years or so. And a 20% more happens roughly about every 6 years. Okay, so when we invest in stocks for the long term, we accept volatility. When we buy a stock or buy an index fund for like the SP 500 or something, we don't buy it with the idea that we may need to sell it in 3 months or 6 months. Okay, Your goal should be long-term. In fact, any money that you might need in the next 3 to 5 years shouldn't really be in stocks or any other investment that can go down in value. Okay, you need to keep that money safe, just like your emergency fund, or if you're in retirement, okay, you need a certain portion that you can always pull from for the next few years. Because your long-term investments, which typically are in stocks, they need to be left alone through those volatile periods. You do not want to panic and sell when the market is down. You want to stay consistent. In fact, when we go through bad years, those are really such great opportunities. If you just dollar cost average, you get to buy through the dip when things are on sale. So at the bottom of this video, in the descriptions, I'm going to put a video of mine on dollar cost averaging. I hope you watch it. It's going to make you feel better if we do have some more turbulent days going forward this year. Now, let's go back and look at this chart. First of all, remember 1987 was one of the worst days ever. In fact, there was a couple of the worst days ever that happened that month in October of 1987. There's that little blip. It's really not even noticeable anymore. This is a chart of the S&P 500. Okay. Here's those 3 bad years in a row in the early 2000s. Okay. Here's the housing crisis. Here is, right in here we had COVID. We don't really see it much because it really only dropped for 1 month and then bounced right back. But in 2022, the market went down 18%. Okay, so we have bad periods, but what does the graph do as we go left to right? It just keeps going up. And this is, if you remember back from algebra, this is an exponential curve. Okay, so in a few years, these periods are going to look just like this one right here. It's kind of an insignificant event. So regardless of what happens this year, okay, even if the market goes down from here, okay, we shouldn't panic. Don't panic sell. Investing should never be associated with your emotions. I know it's easy to get fearful, okay, but we need to be really careful and stay consistent, especially if you're investing through your 401k or something at work. These are really the best times. The bad years are really your opportunity to buy things when it's on sale for a while. We just have to tune out the news and not get fearful, because think of all the bad periods that we just talked about, all those bad days and these bad periods. Yet, what has the S&P 500 done? So this goes through the end of last year, over the last 5 years, up over 14%. Compounded annual rate of return. Last 10 years, over 13%. Over 15 years, almost 14%. 20 years, over 10. 30 years, almost 11. And 40 years, almost 12% rate of return. These down here included all those bad periods we just talked about. Okay, so we don't want to be concerned about what the market is doing in any given month, even really any given year, or even over the course of a couple years. The market sometimes is volatile, and you should expect that when you invest. And when the market does go down, if you can, you want to maybe cut back some living expenses or something. If you could scrape together just a little extra money and invest a little bit more through those periods, you're buying things when they're on sale, and that's where real wealth is created long term. Now, a couple things to keep in mind. I want to go over 3 quotes from Warren Buffett, because he certainly lives by this, that emotions should never be involved with investing. The stock market is a device for transferring money from the impatient to the patient. In other words, don't get emotional, don't get stressed, okay? We want to keep fear and or greed out of our decision making. You want to just have a plan, be consistent, and stick to it. Be patient with your investments. The most important quality for an investor is temperament, not intellect. Again, control your emotions. And number 3, be fearful when others are greedy, and greedy when others are fearful. In the last couple years, we've had a couple remarkable years. If you remember, we looked at those charts, and In 2023, the S&P 500 was up 26%. In 2024, it was up 25%. We shouldn't expect that to continue. It can't continue. That's well above where it should have been. And a lot of people, by all measures, really, the market was kind of overvalued headed into this year. Now, but what happens when the market's doing great? Everybody wants to jump in, even people that haven't been investing. So they tend to kind of like buy high. And then when something like has happened in the last couple of weeks, everybody gets fearful and they don't know where their investments are going to go. So they tend to sell after they've gone down. So a lot of investors tend to buy high and sell low. Well, you want to do the opposite. In fact, you can't time the market though, but you want to just stay consistent and you want to be happy when the market goes down for a long-term investor. Okay? As long as you don't need that money. Now, so a couple things to keep in mind. Don't worry about what the market's doing in any day, week, or even over a year. Zoom out, think long-term. Okay? You're a long-term investor. Remember, volatility is normal. You have to accept that. That's part of investing. Okay? Don't let emotions drive investment decisions. Dollar cost average, I'll leave a video to that below. Dollar cost average. Basically, you get to buy things when they're on sale for a while. And then tune out the news or the noise, both. Because the news tries to sell fear and panic all the time. And that keeps people tuned into the news. And then it's just going to cause you to stress, lose sleep at night. And the best thing you can really do is make no decision at all. Just write it out. The market will come back, keep investing, and you're buying things when they're on sale for a while. And speaking of the news, be careful who you listen to. Okay, and especially professionals and analysts and all those people on TV talking. Because this is kind of happens every single year. This is just a forecast of what some of the largest banks and investment firms across the country expected the S&P 500 to do in 2023. So Barclays thought it would go down 4.3%. Morgan Stanley thought it would go up 1.6%. Citigroup 1.6%. BlackRock 2.4%. Goldman Sachs 4.2%. Okay, Credit Suisse, JP Morgan, at least they had it at 9.4%. Okay, but these are what they predicted it would do in 2023. And what did it do? It went up 26%. Okay, nobody can predict the future. And anybody that thinks they know what the market's going to do for the rest of this year, you probably shouldn't listen to. Okay, I can't predict it. Warren Buffett says he can't predict what will happen over the next year or two. All you can do is feel good about what the market will do over a long period of time. Okay, and you need to not worry about all the volatility. I know that's easier said than done when you see your investments going down. But think of all the fear and panic some people might have been feeling over the last couple weeks. And yet, as I make this video right now on April 9th, your investments are still higher than they were 12 months ago. Okay, even though we're down for this year. What's happened this year is pretty irrelevant. It's pretty small so far. I know it feels like it's bigger than it is, but it's rather normal. We may go down again this year. We may go down further. But if you just stick to your plan, dollar cost average, continue to invest, your future self is going to be very happy. Because if we do go through some more bad periods this year, okay, we don't know what'll happen, but you're buying things when they're on sale for a while. And we've had a lot of bad periods. Okay, the housing crisis, that was completely global. We thought it was a global meltdown of almost every bank. We had major brokerage firms go under, like Lehman Brothers and so forth. Okay, we had the early 2000s we looked at, where the S&P 500 dropped 49% over 3 years. In fact, during the housing crisis, from October of 2007 till March of 2009, the S&P 500 dropped 50%. Okay, so we've had lots of bad periods, but look at what the market has done over a long period of time. Okay, again, investing, we want to zoom out and not get sucked into thinking or worrying about what's happening today over the next few weeks or over even the next year or two. Stick to your plan and just keep investing. Okay, and your future self will be very happy. So I hope this has been helpful, and I'll see you next time.